Hello, and welcome to the Wealth Management Invest podcast. I am your host, David Bodamer, an editor with the wealthmanagement.com editorial team. For this episode, I'm super excited to have with us Joan Solotar, who is the global head of private wealth solutions with Blackstone, which I'm sure most people have heard of at this point. The top alternative asset manager in the world, and has built a very robust business targeting the wealth management channel. So, Joan, welcome to the podcast.
Thank you. Thanks for having me.
So before we kind of get into, a bunch of themes I'd like to pick your brain on, I'd just love to hear, your bio, a little bit about your background and how long you've been with Blackstone and how you've built this, private wealth solutions side of things.
Absolutely. So I've been quite fortunate in my career. I've enjoyed every role, starting with equity research, where I spent more than 20 years, culminating in the role of head of equity research at Bank of America. And then I moved over to Blackstone 17 years ago to help take the firm public, and I established the shareholder relations and public affairs group and ran strategy. And about 8 or 9 years ago, I was asked to take on the role of head of global private wealth solutions and build it out into the world's leader, which is where we stand today.
Yes, it's interesting though, because we are at this moment where folks are talking about democratization and increased access, and there is a lot of product development. But this is a space that, as you just pointed out, that you've actually been in for 8 or 9 years at this point.
Yes, we've actually been serving advisors for about 13 years, but I joined the group about 9 years ago.
Got it. And some of the traditional Blackstone drawdown structures are things that folks have access if they are the qualified purchasers. But in terms of some of these other products that are open to accredited investors, these are a little bit newer, correct?
Yeah, I would say what's really new is that you now have institutional quality firms offering funds in private investments that can reach more and more individuals, really than ever before, on the one hand. And on the other, that whether you're a big wirehouse firm, global private bank, et cetera, family office, that the ability to access these funds in an open-ended structure, which makes it easier in many ways, no capital calls and the like. And that from a regulatory perspective, these can be accessed by individuals, often with $1 to $5 million, but even less in investable assets, has been game changing.
Right. And some of the features that I've often heard referred to in terms of these being attractive are, the tax reporting is simplified, the lack of capital calls that you just mentioned, the minimums being lower, the liquidity sleeves, the limited liquidity sleeves on these, but that all of these kind of mechanisms making these funds just friendlier to more investors. Is that right?
I think that's right. And if you go all the way back in time, I think about at the time that we went public, really was by and large institutional investors only who were able to access private markets. And if you look at how they've been allocating, let's say on average, they're allocating somewhere between 20+% for pension funds and over 50% for foundations and endowments. These were just not even available to most individuals, and today they are. And the assessment is that you probably don't need to access all of your investment dollars, most people anyway, every single day. And so why not get the benefits of diversification and higher returns and lower volatility in the same way that institutions have been able to?
In terms of the asset types, Blackstone touches so many different geographies and asset types. The type of stuff that we're talking about right now includes private equity, private credit, real estate. My understanding is an infrastructure also is going to be made available as well.
Yes. The way I would think about it is the private markets are substantially larger in all of the asset categories that you mentioned than the public markets.
Mhm.
And so I think putting those assets into funds for both institutional and private wealth individuals is just going to become more common and has been. And, when I mentioned allocation on the part of institutional investors, it wasn't that high 20 years ago. It grew over time, just like you're seeing with individuals. So as more and more companies create these offerings, as we continue to develop more offerings, as we continue to develop areas where we're investing in. And, I should mention, I think one of the interesting and great things about Blackstone has just been innovation around finding new investment opportunities, right? We started in
Mhm.
private equity, then moved to real estate, on, built scale businesses in all of these areas. And so being able to put them in structures that are easily accessible, that are more flexible, is something that we aim to do, and which has been received with positive receptivity on the other side. So yeah, I would expect these asset classes. I think you'll see more regional offerings, and I think you'll see other asset classes come into the fold as well.
Hmm. And so how do you assess that? Like when you're looking at, either getting into, like, what does the process look like, in as much, however you can talk about it, in terms of like thinking about product development or thinking
Yeah,
about making a new asset type available, like
yeah.
to an investor class?
So simply put, we look at first and foremost, what will be the enduring experience for the end investor? Meaning, what does the net return look like? What does the volatility of that asset class look like? Do we think we have the ability to continue to invest in all different types of environments? Do we have the right teams in place to be able to invest as money comes in, whether it's monthly or quarterly? And can we build something of scale? On the private side, unlike public markets, scale really matters
Hmm.
because depending on which asset class you're talking about, typically larger companies are more proven, they're more stable, whether you're talking about credit, real estate, certainly having scale matters. Being able to create a very well diversified portfolio, being able to speak to an entire asset and control it, all of these things, scale becomes a big advantage. But I would say our true north is really around what is the net return that we believe we can provide an investor over time.
And so what has the process been like in engaging the advisor audience and getting people to understand the opportunity sets, onboarding, maintaining relationships? What does that all entail?
So you touched on one of the most important areas, which is education. And, as a reminder, I said we've been at this now for 13 years. Education comes in multiple forms. We have our, what we call Blackstone universities, where we bring together groups of advisors and we talk about the different asset classes, their attributes, how the different structures work, how liquidity works. We do case studies and the like. But I think even more important is the daily interaction that we have with advisors. So we
Hmm.
have 150 client-facing individuals around the world. We have a very large investor services team that may not sound like the sexiest part of the business, but it's actually one of the most essential because buying these types of investments and these structures is not like buying a stock or bond. Hopefully someday it will be, but it's not today. So we spend a lot of time both sharing insights, what we're seeing around the world from all of our portfolios, and also teaching advisors about these asset classes. Because although there has been tremendous growth, if you look at the $80 trillion private wealth market and the penetration of private investments, it's still tiny, tiny, tiny. So I think we have a very long road ahead. I think a lot of advisors are still not fully educated and therefore not confident enough to use these funds. But that is changing. We've seen it changing over more than a decade, and we're still on that long road. But education is paramount.
So, and then in terms of that like ongoing engagement question, what is it like? What kind of information are folks looking for? Are they looking for performance metrics, and then how do you handle that since some of these assets are, since we're talking about private assets which don't have like, they're not kind of going up and down on a ticker every day, like,
Yeah,
like
exactly.
there's a very different kind of timeline and a different kind of process. So is that like part of the challenge, just like getting people to understand like how the way that the asset types and how private markets are just fundamentally different, and there can be, obviously ways that you can try to increase transparency, but also, people just have to understand that the kind of assets they're working with work on a different way.
I think that we get all sorts of questions
Mhm.
for information, and we are quite transparent around what's in the portfolio, how we mark assets, and we have about a 40-year history of that. So I think investors ultimately take quite a lot of comfort in that. I would say the areas where we're spending a lot of time and where the questions come in are often around asset allocation, how to use these assets in a portfolio,
Mhm.
where the money should come from, if you will. And so we spend a lot of time on that. There's tons of questions just around what we're seeing in the market and where the opportunities are. In many ways, several of the strategies are all weather, meaning that they can perform well in different market environments. They can provide diversification in different environments. And so just speaking to how these funds act in those environments is also quite important. And we get a lot of questions around differentiation. So investors and advisors looking under the hood, wanting to understand, why is your real estate portfolio performing in a certain way versus someone else's, and then taking them through the portfolio itself. Like, oh, well, we
Mhm.
have fast growing data centers, we have fast growing, student housing, we avoided offices,
Right,
so they
right.
really get into the weeds of what's in the portfolio.
Yeah, I could imagine there's, probably a lot of challenges around this misconception of the commercial real estate market, for example, where like there's so much attention paid to the office sector when and I think there's oftentimes an assumption that the office sector accounts for a very significant portion of the investable commercial real estate universe, when in fact it's kind of, it's not even 25%. I forget, the numbers
I
vary over
believe it's
time.
15%,
Yeah. And so A, it's not even like a major part of the overall universe, and B, like you were saying, in terms of like the kind of assets that Blackstone's been investing in, you may not even be touching that at all.
Well, it's interesting. I think you always have to try to distinguish the signal from the noise.
Hmm.
And there is a lot of noise around office and the like, but in many ways, that's looking backwards. And when you're investing, you need to look forwards. So we already saw the decline in office, we saw the decline in value, and some who own it are catching up in terms of the marks, and others
Hmm.
who have loans, maybe they've been able to meet those payments for some time and they're determining, what to do with those assets now. But I think what's most important is the look forward. So what is your going in price today? What do those assets look like going forward in terms of their yield and their return, and the opportunity set is most essential. And so, what you may read about is often the most provocative of what's going on, but being able to say, okay, that's one example in a portfolio, as opposed to painting the broad brush that that's all real estate, I think is essential. I also think because of what we said earlier, which is, 90% of commercial real estate is private versus the 10%
Right.
that's public. And we tend to hear much more about what's going on the public side. And that is more volatile. As you mentioned, that gets marked every day, up or down. And it could trade at a premium to net asset value. It could trade at a discount.
Hmm.
And so it tends to have much wilder swings. Private real estate doesn't really move that way. And you can see supply coming, buildings don't just pop out of the ground. So you really can make some great assessments on what the trends look like, where we will see opportunities from supply demand imbalance and the like. And that's what Blackstone's really been doing since 1991 with great success in real estate.
Yeah, I've had a career prior to covering investments for wealthmanagement.com, writing about real estate, commercial real estate. So I do have like a little bit of my own history, and it's been somewhat aggravating to see some of the way that the narratives get smushed like in
Yeah,
the last couple of years. So I very much appreciate, like what you're saying around real estate. And I've also been a long time watcher of Blackstone from that seat as well. So
yeah.
anyway, just an aside. But you also talked about another interesting thing there, which a couple of points back, which is around this idea of portfolio construction. Because I guess, in recent years, there's been this whole talk of, given the performance of the 60/40 specifically like in 2022, that in some, and then like that in turn has, I think, been part of what's informed the conversation around like, well, maybe, like getting away from that model and incorporating alts and thinking like, whatever percentages get thrown around. I don't necessarily think there needs to be a hard and fast numbers around those things, but just that process, the performance of the 60/40, kind of creating a new urgency around this idea that maybe you're not achieving diversification. If it's not achieving some of the goals it's supposed to, then that's where private assets can achieve some of the things that people were looking for, that they thought the 60/40 could accomplish. So I guess, like, in terms of the portfolio, so it in terms of thinking about the like rebalancing portfolios, is it as simplistic as thinking like you should take some of the equity allocation, move it into private equity, and some of the fixed income into private credit, and maybe a little bit of both into some of these real assets? Or how does that reallocation and portfolio construction conversation go?
Yeah, I think it really varies by the client and the portfolio with which they're starting. So think of it this way. If you have a 60/40 allocation and you have tolerance for illiquidity, whatever the percentage is, and your main goal is to increase your total return, that would suggest that you probably tilt more towards equity and private equity because of the asset classes that we mentioned, that could generate the highest returns if at least based on what they've done historically. However, you may be in a position where you're actually looking to augment the income percentage of your portfolio. And then you might be looking at areas like real estate, which has tax efficient yields, or private credit, where there's a very large spread to fixed income or infrastructure, and the like. So it really is hard to say that there's a one size fits all. It's very much bespoke to that individual. The second piece, that's on return. And the second piece is around diversification. And there you probably do need a bit more of a sophisticated model just to see how these funds act with what you already own. And then the last piece is volatility. So if you looked at the private asset classes of private equity, private credit, private real estate, and you looked at their public counterparts over time, they tend to be not just higher returning, but also less volatile. And so, you can look at what these do to your current portfolio to see, okay, how much do they increase my return, improve my diversification, reduce the volatility, and then what am I giving up in terms of liquidity? So I think it always starts with the liquidity question.
Got it. And whether that's something that somebody should or could tolerate, having a certain percentage that's going to be either illiquid or at least substantially less liquid.
Correct. And to generalize, a very wealthy individual should be able to tolerate a greater percentage of illiquidity than someone who is starting out and has a much smaller portfolio. And the other piece of the puzzle, of course, is how long can you hold these assets and the power of compounding. And this is essential to me. So if you think about a fund that can generate a 12% net return over time, for example, over 10 years, you can more than triple the value of your investment. And so even though there are liquidity options, quarterly liquidity or monthly liquidity, we really think of these as much longer term because the assets are longer term and because the power of owning them is in that compounding effect.
So in terms of the overall evolution of this space, I think it's fair to say Blackstone enjoys certain advantages given name recognition, scale, folks know you've got a track record, you've got these massive platform that touches all this long history of funds. How else, but aside from what you guys are doing, what other factors do you see helping drive the growth here? Are third-party platforms important? Are what we're trying to do on the media side, what else needs to happen to see the continued maturation of this market?
Yeah, it's happening, and it will continue to happen everywhere in the world. And so what you mentioned is an important element. So it's being able to solve the friction points at each part of the process, that is key. If we ever get to the point where buying a private equity fund is as easy as investing in a stock, I see no reason why the market share, wouldn't be many, many multiples higher of where it is today. But you have a lot of technology companies, whether it's companies like iCapital or Case, paving the way, All Funds and others outside of the US. These are all aiming at the margin to really make the process easier for both the advisor and for the investor. But we still have a long way to go. And it's not just those companies, it's also the building out of technology on the part of our private wealth partners. So many have had to build new capabilities just to process these open-ended funds. And I just think that it will become an imperative if you're going to be competitive. And two, it will continue to get better. But it just takes time, unfortunately, and we wish that it didn't. But you still have many advisors continuing to fax over documents, get wet signatures, fax back.
Mm-hmm.
That will just be automated over time. It needs to be, but we're not in a position where that's actually the most common. So that's why I also am confident that we're pretty early days here.
I mean, do you think that's something that we'll see within a year or 2 years, or is hard to, it's just too hard to say, like how we get to the period where it might be like a one click kind of thing?
I think we won't get there in the next few years.
Okay.
There will be certain structures that will make it easier to invest, perhaps, but I don't think that the kind of technological changes that are underway will be complete in that short period of time. I wish I could say that it would, but I think in 5 years, we will see real differences. If you go back 5 years, I think back, I was refinancing my mortgage. It was the middle of COVID, and I had to get a wet signature, and I was standing out in the rain under an umbrella signing a piece of paper. Today you would do that with e-signature on your computer. So, we've already made progress, but there's still a long way to go, and it typically takes longer than you would imagine.
So, and in terms of just 2024, are there any themes that, just for the first, we're just short of, just a little bit past the halfway mark. We're recording this will come out a little in a little bit after we're recording, but we're just a little bit past the halfway year mark. Anything that kind of stands out in terms of like themes for either on the the asset side, or any other like kind of trends, just in terms of the first 6 months, and anything in terms of that we should be looking out for the back half of the year?
Yeah, sure. I would say in terms of themes, one is that because banks are paying, and this is in most, perhaps not all, but most parts of the world, good rates to attract savings and money market accounts, you're seeing a wall of cash sit in many investors' portfolios that will ultimately get reinvested. But today, I think there's a bit of complacency. If you can earn 4 or 5%
Right.
in money market funds. So as we go through the year, we think interest rates are likely to come down. I am not predicting where they will go. I certainly don't know. But I think the kinds of rates that folks are earning today on those short-term savings accounts will go down. And I think investors will want to redeploy. We are continuing to see substantial interest in private credit. So spending a lot of time there. And again, that's all over the world, US, Europe, and Asia. I would say the same on the equity side. And as you mentioned, commercial real estate is an area where, we've seen values bottom. So if you look at commercial real estate values, just the last 6 months, they've been flat to up. We don't see any kind of V-shape, recovery. But I think we are through the worst of a down cycle, which really was caused more by rising interest rates, and certain sectors had other troubles. But if you think about credit spreads and values related more to interest rates than anything else, that should start improving as well. And so in real estate, if you can survive till 25, and we will do better than survive, I think you will start to see greater interest. And we're seeing that at the edges, but I would say it's still an asset class that remains somewhat unloved, or at least less loved than private credit and private equity.
Well, I've taken a fairly good chunk of your time, which I very much appreciate. Before we kind of wrap this up, is there anything that I didn't ask you about that you think would be a good point to leave the audience with, or anything that you kind of wanted to just put a button on?
Yeah, I think what's most essential is to really understand that if you're not investing in private markets, you're really investing in such a narrow part of the investable universe. And today you have access to high quality, institutional quality managers. And of course, you have to do the due diligence, work with your trusted advisor. But I would just suggest, take a look at your portfolio. And if you don't have private assets in there, I think you have to ask the question, why not?
And if folks want any more information or to reach you, what's the best way to do that?
So we have, certainly they could go on the Blackstone website. We have a private wealth area where there's lots of information, including contact information. And, we're happy to just talk and provide education, information, whatever folks are interested in.
Great. Well, thank you. Thank you so much for your time and for entertaining my questions and providing all your valuable insights.
Well, thank you for having me.
And thank you to you both for having this conversation. And thank you for listening. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.